it doesn't bode well if the president got on a plane today, went down to Fort Knox and opened up, and either some of the gold or none of the gold is there. It doesn't do the United States really, really well. Very, very interesting times. But the continuing unstoppable purchasing of gold by central banks is the single biggest supporting factor. They're not buying Bitcoin. They're not forming a quasi, and it's a BS calling a strategic reserve when you're just taking something out of the lost and found and putting a sign on it now. But the bottom line is the gold market has so many strong bullish underlying fundamentals that suggests, as long as I think we make a technical base that's strong enough to hold, that we'll eventually get above 3,000 this year. And who knows then what the number could be after that.
Until recently, gold's price rose steadily but slowly. The market price didn't grow much for about 55 years. Now that the new gold rush is underway and gold has reached almost $3,000 per ounce, it's worth considering the nearly $750 billion America's gold stash might be worth. Expert and trader Peter Grandich criticizes the mainstream media for ignoring gold's strong 25-year performance. He also pointed out that central banks continue to buy gold heavily, supporting the market. Official central bank gold buying started in 2025 the same way it ended in 2024, strong. Globally, central banks added a net 18 tons of gold to their holdings in January. A World Gold Council analyst said, "The sustained buying highlights the strategic importance of gold in official reserves, particularly as central banks navigate heightened geopolitical risks." From a technical perspective, Grandich underscores escalating geopolitical tensions, including Trump's unusually aggressive comments on Iran and Gaza. He emphasized that such geopolitical instability historically benefits gold as a safe haven. Following the unresolved mineral deal and ongoing disputes between Trump and Ukraine, Trump has withdrawn all U.S. military defenses from Ukraine. Meanwhile, the EU has proposed €150 billion in new loans for European defense. These geopolitical tensions could slow oil's steep downturn and further boost gold's safe haven appeal until a resolution is reached. According to Grandich, a recent story suggested that the new U.S. administration might have discovered a discrepancy in Fort Knox's gold reserves, adding intrigue to the gold market. He criticized the U.S. Strategic Petroleum Reserve Management, contrasting it with the strategic importance of physical gold holdings. Speculation is swirling that the U.S. will revalue its gold reserves to fund the purchase of crypto. While not a base case, that possibility should be taken seriously given the potential knock-on effects on the Federal Reserve's independence. Now we present the clips of Peter Grandich's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think I hear somebody from the mainstream media saying something about gold. Oh, I'm sorry. I thought maybe they might say something about that. After all, it's outperformed their most talked about investment stocks and bonds for 25 years. And they can't even get a mention. Copper goes up 5% in a day. Pin drop. That's all good, even though you're frustrated because you like to turn on the mainstream media and hear somebody confirming. But we know, we've seen the performance. Look at the tremendous move in gold in just 2 years. Now, I've been in the camp, and, people that want everything to go straight up don't understand that markets are always best when they go 2 steps up and 1 step back. And we had a huge move from just under 2,000 to just below 3,000 without a serious correction or consolidation during that period. And so if you want prices much higher than 3,000, we need a base just under it to give us that foundation that would hold so we don't go quickly above it like a bottle rocket, explode, and then just fall back to earth. So I'm very, very bullish on the gold market. The silver market is starting to peak up. It's still in the back seat next to gold. But, I suspect when it takes out the key number, which will bring all the momentum players in that 35, 36 area will go. And of course, the copper market is trading, just couldn't ask for better. So despite not hearing it outside the limited industry that we work in, it's still very, very bullish scenarios for the metals, and not even a beginning or a hint of anything serious in terms of downside risk. But Trump's comment about Iran today was the most aggressive I've heard in years by a president of the United States. He's basically said that they're basically running out of time and the fuse is short. Now, we know just a couple of days ago, he made a statement about Gaza that if they don't release the hostages and do it all quick and all, they're dead, death. I mean, this is the president of the United States saying this. And then, of course, today he's basically implied that they cannot have a nuclear weapon and the time has come really, really short. Now, when you tie that into some of the things Israel has said, when we tie it into Iran in recent days, have noted how they've been refortifying their nuclear facilities, and then even put out a statement a couple of weeks ago that even if they do get bombed, they'll have the ability to build new ones elsewhere. It suggests to me that the Middle East may be getting set for one of its biggest confrontations, more so than we've even seen in recent years. So you have the Ukraine, you have the Middle East. Taiwan is still having those issues with China. We just had China basically say, if you want war, you want a trade war, you want a regular war, we're ready for it and we're ready to fight to the end. I'd say the geopolitical picture is not a pretty one. And there's multiple areas where things go wrong. That's beneficial to gold, Elijah, but make no mistake about it. The central banks continue to buy gold. We saw the repatriation, and now we're seeing this movement of gold. And maybe it was a question, and I hope I'm not jumping you, but there was a great story out today, and I put it out, and a guy made a lot of sense, circumstantial evidence, but it made a lot of sense that a key reason for this gold to come back is that this new administration basically discovered that Fort Knox doesn't have all the gold that a lot of people said it had. Because it made no sense to me, Elijah, why a couple of weeks ago, why would you bring up as the president, yeah, we're going to go there and open the door and see what's there. I mean, it doesn't bode well if the president got on a plane today, went down to Fort Knox and opened up and either some of the gold or none of the gold is there. It doesn't do the United States really, really well. Very, very interesting times, but the continuing unstoppable purchasing of gold by central banks is the single biggest supporting factor. They're not buying Bitcoin. They're not forming a quasi, and it's a BS calling a strategic reserve. But the bottom line is the gold market has so many strong bullish underlying fundamentals that suggests, as long as I think we make a technical base that's strong enough to hold, that we'll eventually get above 3,000 this year. And who knows then what the number could be after that.
Based on fundamentals, Peter Grandich states that the dominance of gold trading has moved to Asia, where gold buying is culturally and governmentally supported. Grandich believes the Trump administration might revalue gold to bolster the U.S. balance sheet. Much attention has recently been focused on U.S. gold reserves, especially the stockpile in Fort Knox. While Treasury Secretary Scott Bessent dismissed the possibility of revaluing the stash of gold to market levels, an analyst said that would be bullish for prices which have already been on a tear. According to a Wall Street analyst, revaluing U.S. gold reserves to match current market conditions would add more momentum to prices, as it would signal the precious metal isn't an anachronistic asset. While shifting toward financial issues, Grandich is skeptical about reducing U.S. debt. Paying off the debt is unrealistic. As concerns about the U.S.'s ability to make interest payments rise, there could be significant pressure on bond yields, potentially leading to a crisis around 2026 and 2027. Less investment means slower productivity growth, which in turn means the living standards of future generations will be lower than they would otherwise be. Thus, rising debt as a share of GDP over the coming decades means that future generations will be worse off than if less debt was accumulated. However, economic growth means that future generations will still be better off than current ones. Let's get back to the interview.
There is a real positive that a lot of people don't speak about simply because it's not around anymore. And when it does show its head, it only lasts for hours now. But we have to remember, if anybody that's been involved in the gold market for the last several decades, that the paper market greatly manipulated versus what happened in the physical market. That the London and COMEX, or some of us like to call it the CRIMEX, seem to be able to manipulate the paper market of the paper price of gold and suppress the rise. Everybody goes, well, but it still went up, but we still feel it would have went up a lot more if it wasn't for that suppression. The argument for the suppression has always been is that these people have written derivatives, kind of like the movies, The Producer, where they sold more than 100% of what they had. And the clear indication when gold trading really moved to Asia and became dominant there, in an area of the world where people are, Americans are going into malls on the weekend to buy things they can't afford. Chinese citizens are going into malls on the weekend to buy gold, and the government supports them. So that paper market that used to be a negative to the gold market is all but over. When we have a $30 or $60 or $70 down day, years ago, they could last for months. Now they last for hours or maybe a day or two. And that's another very, very bullish indicator, and also plays into the hand in the roll that there could be a lot of people caught with their pants down, so to speak. And the government recognizes that, and there's no question that one of the things I believe is on Trump's administration's mind is to revalue the gold. It makes sense for them to do that now, especially a country that's so indebted. It'll give them some breathing room to borrow money if they can, start pricing gold at least near what its current price is. Now, there's people talking about it pricing it at $5,000 and all. I don't think they could justify it pricing it above where it's trading, but I certainly think they're going to revalue it. And that's just another bullish factor for gold overall. The bottom line is, if you think about an asset sheet right now, you have a business and all. So now let's just say it's worth $5, but because you revalue it, it's worth $300. More people, banks and all, will be more willing to deal with you because you have more of an asset base than you had. Listen, people get mad when I say this because I get from both sides, because I'm neither a Magna or a Trump hater. I like the man for a certain amount of reasons, and there's some things I don't really care about. And the one thing that he's never been in this entire history is an austerity person. He's a great believer in debt and the leverage of debt. We've seen that in businesses, and sometimes it caught him into some serious problems. So I don't believe there's a motive or a hidden agenda to somehow do all this so we can reduce the debt. I do think they want to make an honest effort because they recognize as business people, you can't keep running $2, $3, $4 trillion deficits, because even if that stops now, still having $36 trillion in debt, we're never paying that off. It's ridiculous. He did make that comment once or twice that we're going to pay off the debt. How could a country where 2/3 of its workforce is working paycheck to paycheck, and a government only exists on the taxing power that it has from its citizens, how could we ever expect our working force to come up with enough money separate from everything that it needs to live to pay back $36 trillion that we owe? And that's one of the things, concerns about long-term for the bond market, that I think people should just put in the back of their mind now. Yes, interest rates have come off a little, they've come lower, and that's decent. But there's going to come a time, whether the economy is strong or weak, that bond yields can go greatly higher if people become more and more concerned of our ability to pay the interest. I don't think people even worry about the principal anymore. I don't think they ever expect that. They just hope we can keep paying the interest so the debt that they do have outstanding can be refinanced and they can be repaid. That's probably a 2026, 2027 issue, but we are getting to that point where people around the world are starting to ask, can we make these interest payments, especially if we don't get all of these deficits and they keep just going up? I mean, if you think about it, we're going up $1 trillion basically every 30, 60 to 90 days. That's totally unsustainable.
Van Eck says gold prices can increase in 2025 as investors seek protection from uncertainty around U.S. trade policy and debt levels. With the U.S. debt continuing to rise and geopolitical risks mounting, could the revaluation of gold reserves be a realistic strategy for stabilizing the economy, or could it introduce new risks to the financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.